Hello, welcome back guys. In this video we are taking a look at Adobe. After its recent Figma acquisition, the stock actually dropped down quite significantly. You can kind of see it in the chart over here, a precipitous decline over here of like 20% or so in just the past few days alone. And right now the stock is actually sitting at $291. Now in this video of course we are going to be examining the financials of Adobe and whether it's a potentially interesting buy over here. I wanted to point out to this specific article here that I was reading earlier about Adobe, and it basically discusses that buying Adobe today you get Figma for negative 16.5 billion. Now we're going to examine what Adobe did here and whether they overpaid for Figma, for instance, and also whether the stock price is actually cheap right now, especially in comparison to what it was worth in the past. Now, if you take a look, of course, at this article, you're going to see a lot of different things about Adobe and how they have been doing in the past. But what I wanted to focus on is the Figma transaction details here. So the company is paying about 20 billion for Figma, which is about half cash and half stock. This means, in case you're not aware, that the company, Adobe that is going to be paying about 10 billion in cash and 10 billion in stock. And in order to pay 10 billion in stock, the company will more than likely have to issue some extra shares pretty much and basically pay, dilute shareholders or pay with that stock. That's kind of the typical way of doing that. And as you'll see, 6 million additional restricted stock units to be granted to Figma's CEO and employees that will vest over 4 years subsequent to closing. So a little bit of extra dilution over here. Now, of course, you can go back to our tool here and see that Adobe currently has about 469 million in stock. And so what we are seeing here is 10 billion in extra shares that the company is going to be paying with. And currently, you see the market cap of the company is about $135 billion. So 10 billion extra shares here would mean that we are getting an about like 7 to 8% dilution. Again, it's like 136 billion over here. We're going to be getting 10 billion in pretty much market cap, which is going to be translated to stock that the company is going to be paying with. So let's do a little bit of a quick calculation to see how that actually works here. So if we do the division, we're going to get that $10 billion divided by 136 over here, which is again the market cap. We're getting multiplied by 100, of course. We're getting a 7.3 in terms of dilution over here. So we're going to be having a 7.3% dilution from our current stock float, pretty much outstanding shares. Plus, remember this as well, plus 6 million additional restricted stock units to be granted to Figma's CEO and employees as well. So we have to factor that in too. And what is that compared to the current outstanding shares? Let's actually calculate that too. And so very simply here we can do like, that was, again, if we go back, it was 6 million, that is in shares in this time. So again, we're using our calculator. We do 6 divided by 469, the current outstanding shares, multiplied by 100, and then we're getting another 1.2% in extra dilution over here. So remember, we had 7.3 plus 1.2 here, so we're looking at an about 8.5% dilution in total here. Upcoming, pretty much, is what the company is going to be basically paying with as part of the overall transaction here, plus 10 billion in extra cash that the company is going to be paying. So there is quite some significant dilution going on here. Again, like 8.5% plus the extra cash that gets that the company is going to be departed from. And you will see here that the company, again, we can take a little bit of a look at, let's say, the 1 week chart here. At some point, it was sitting at almost $400 over here, back in September 12, that is. Now, I think the acquisition details happened in about 14th of September or so, and then it started the big drop. I think September 15th was the day, and so we had this massive drop over here of about, I believe it was about 20% or something of that sort. Again, yeah, you can kind of see it here, it's about 20% indeed. So what we want to be understanding here is whether it makes sense for us to be buying the company based on how much it has dropped and based on how much they're going to be paying for their acquisition here. So again, we know that the company dropped about 20% at some point, and then it actually is going to be diluting shareholders by about 8.5%. Now, this 20% in terms of its drop, you can very quickly see, if we go back and do the calculations, that before pretty much the announcement of these results, the company stock price was 371 over here. So again, we can use our calculator, 371 over here, the stock price that is, and multiplied by the amount of shares, 469. And you'll see here that we're getting an about $174 billion in previous market cap. So it was 174, and right now it's $135 billion in terms of its market cap. So we are looking at a pretty significant decline here again of its market cap, of the company's market cap. And so as this goes down and as the stock price goes down, we can actually discover whether it makes sense to be buying based on the data that we have right now. And let's just try to focus on that and see whether we're getting the stock at a good price if we actually buy today based on what we have already seen. So the way we are going to treat this from now on, when we continue our analysis, is add an 8.5% on top of our calculations here. And of course, we're going to see that using our stock evaluation tool, because we know that there's going to be this kind of dilution going on. And so we will actually adjust our calculations to include this kind of dilution that we know it's going to happen because of the acquisition. Again, we saw the details over here. Okay, so the first thing to see, of course, examine the core financials. PE that's been going down, and it's awesome to see. It's still a little bit expensive, but may not be that expensive. And again, the price to free cash flow is still sitting at 20, which is pretty nice over here. The outstanding shares, again, they're going to be increased a little bit. We saw that, and we know that this is going to happen. We will factor it in our calculations. The company is very solvent, 1.8 in terms of its total liabilities to free cash flow over here. And the nice thing about it is that it increases its revenue growth, its net income growth, free cash flow over here very nicely as well. And the total equity growth too, without them actually issuing extra shares, which is very, very nice to see. A very solvent company with amazing margins as well, as you see here. Very high margins. They have been suppressed a little bit, but still very high. Great returns on equity without a lot of debt. So things are looking very nice here for this company. I like what I'm seeing. Now, I'm gonna continue and take a little bit of a look here at the company's stock evaluation tool analysis, pretty much. And again, remember that we're going to adjust that for the expected dilution in the very end. Now, in terms of revenue growth, the company has been growing quite a lot, about 20-22% pretty much a year, as you'll see over here. Now, we will go more conservative, of course, because that's what we are doing here. We want to be getting a better price. We want to have a margin of safety. So I'm going to go 8, 10, and 12 here and see what we get. In terms of net income margins, about 30% is the average, which is absolutely very, very high and very awesome to see. And I will go 25, 27, and 30 over here. The free cash flow margins that the company generates seem to be typically above 100% actually. And for this reason, we are going to go 100, 110, and 120. This is very, very typical for what the company is doing over here. You see the average about 140%. In terms of the annual return, you will see that we are adding 13%, the typical one that we usually ask for. And now we hit calculate. And you will see that the current price is sitting at 291, and our low, medium, high estimates here are sitting at 267 over here. And again, as you can understand, we have a little bit of an addition here to do here. What we want to be doing is adding this 8.5% on the current price. And so we can go over here and do something like 291 multiplied by 1.085. So basically add this 8.5% on top of the current price. And you will see that the price that does make sense to calculate for, just because there's going to be this extra dilution, is this 8.5% addition on top of the current price of the stock. So I would actually calculate for 315 as the current price of the stock, even though it is sitting at 291, because of the dilution, because there's going to be more stock pretty much added there, effectively diluting the value of our current stock, and basically means that we're paying more if we acquire it. Now, based on 315 over here, we are still a little bit expensive here in terms of Adobe. But again, you always have to factor some facts here about the company. The fact that they have amazing margins, for example, and the fact that they grow their revenues very quickly. So it may make a little bit of sense to be paying a little bit more for this one. And so it's been getting cheaper, and I kind of like what I'm seeing here. I would like to get it at a cheaper price. This kind of Figma acquisition looks like it has dropped the stock more than expected, frankly, more than you would expect here. You'd probably expect about half of the decline that they have already had, like maybe 10%, something of that sort. You can, of course, calculate it exactly based on what the company will be diluting and what the company is actually paying. And you also need to factor the cash that they're going to be departed from, of course. Overall, I think it's getting kind of interesting here. And if it goes down a little bit even at this current price, it may actually be a somewhat interesting opportunity. And remember that I used 12% for a revenue growth, while the company has been typically making 22%. Now, again, at this current market, you never know what's going to be happening, of course, and we probably do expect some at least short-term decline. But 8, 10, and 12, I think is very, very sensible here, and even my margins are suppressed here. If we're sitting at a normal, I guess, economic cycle, this could easily be something like 12, 14, and 16, let's just say. And even then, that could be pretty normalized. And maybe 27, 29, and 30 here. In which case, we would be getting something like this. And then we are actually exactly pretty much where we'd want it to be over here. And it would be pretty much a buy. Very interesting company. Very, very interesting to see Adobe getting cheaper here. Much, much cheaper than the past. And again, you can kind of see it over here very vividly from the stock price that it has been going down quite significantly from where it used to be, almost 60%, presenting ourselves with a potentially very, very nice opportunity. So tell me what you think about Adobe, guys. Remember to leave a like and subscribe if you're new around here, and I'll see you in the next video. Thanks for watching this one. I'll see you soon. Bye-bye.